Stock markets and risk sentiment have perked up today as investors have observed the news about aggressive stimulus measures adopted for the world's second-largest economy. This time, the reason for optimism was the official report from the Assembly of the Chinese Politburo. It reads about necessary budget expenditures to achieve the country's GDP growth target of about 5%. Beijing is reportedly considering injecting up to 1 trillion yuan of capital into its largest state-owned banks. This will be the first such step since 2008 and indicates the urgency and importance of the stimulus measures. Traders also remain focused on the central banks whose currencies are included in the US dollar basket. Today, the Swiss National Bank lowered rates by 25 basis points, although the market had expected to cut twice as largely as 50 basis points. This triggered the strengthening of the Swiss franc against the US dollar and the euro. However, this reaction pales in comparison to the volatility that will likely hit the forex market later today during the speeches of the central bank leaders in the Eurozone and the US. In the statements from Christine Lagarde and Jerome Powell, markets will look for additional clues regarding the future of interest rates, particularly in the United States. Frequent revision in forecasts regarding how aggressively the Federal Reserve will cut the funds rate this year and the next have kept the US dollar within a narrow range over the past months. Interestingly, today, the US dollar seems to back in favor. In other words, investors are once again moving out of stocks in favor of the safe haven currency and other assets. As a result of this shift in market sentiment, the US stock market will open lower, unlike in Asia and Europe. The S&P 500 index is trading in the intraday corridor between 5,712 and 5,742 on the daily chart. The US dollar index, which tracks the greenback trends against the 6 major currencies, recovered last week's losses yesterday, rising by 0.8%. It seems that the US dollar is again winning favor with investors, especially during times of uncertainty and the falling stock markets. Thus, the dollar index is consolidating today, trading within the range of 100.80 to 100.10. As we can see, the US currency is showing signs of a fatigue in the long term. Since the US dollar perked at 106.50 for the year in late April, it has already lost nearly 6%. Its reaction to the release of the US economic data could further reinforce this trend. For example, yesterday's 4.7% drop in the new home sales is clearly not helping the strengthening the US currency. The data on the US GDP published today is unlikely to affect anything because revised data will be released. The fresh report must only confirm preliminary estimates that have already been priced in by the market. The report, worthy of note, is durable goods orders, which could tumble to minus 2.6%. The weekly update on the first-time unemployment claims, if confirmed, will become an additional factor of pressure on the US dollar. If the figure comes out of the estimated level of 225,000 or higher, this will mean a further cooling of the labor market in the US. It's another argument for the Federal Reserve in favor of a rate cut. In other words, the balance of trading forces on the forex remains unchanged. Fresh economic data is accompanied by high volatility, and today the euro-dollar pair briefly surpassed the level of 1.1200 during market speculation. However, market participants failed to secure the price above this landmark level. As a result, the instrument pulled back. Meanwhile, the currency pair continues to hover near the peak of the uptrend channel. The euro reversed its decline, which was triggered by the latest reports from the European Central Bank and is now supported by the protracted weakness of the US dollar. For the next stage of growth, the euro buyers need to settle the price above this level today. If successful, the odds are that the instrument will reach a new high, surpassing the level set in July 2023 at 1.1276. Otherwise, the euro-dollar pair will go ahead with the fluctuations around current levels. Amid opposing trends, the advance in the US dollar and the Chinese economic stimulus, oil prices chose to decline. The oil market behaved usually. Once again, despite a recorded decrease in the US oil inventories by 4.5 million barrels last week. Instead of rising, crude prices confidently heading downward. A similar situation occurred in the late August and early September. At that time, there was no reasonable explanation, and the same pattern is repeating now. Brent futures reached the resistance zone of $75 and $76, where traders cut on long positions. This led to stagnation, indicating the probable end of the correction cycle within the broader downtrend. If this trend is extended, Brent prices could move toward the recent local low. Considering the escalating clashes in the Middle East, it seems that market is once again under speculative pressure. The main catalyst is the expectation of increased oil production by OPEC and its allies. However, the sharp decline in prices almost a month ago forced the cartel to delay this decision for another month. If prices do not rise, OPEC Plus may give up this move, and most likely the pressure will persist and crude oil prices will continue to decline. The Russian ruble is staying aside from the overall rise in volatility and maintains stability today. Despite a decline in industrial production growth from 3.3% to 2.7%, the actual figure came in slightly worse than estimated 3%. It should have put pressure on the ruble. However, the dollar-ruble pair is still sticking to the lower border of the narrow range of 91.70 to 92.50. This alone suggests a potential reversal and move toward the upper border. In other words, we can expect a local weakening of the ruble within the current range, but the overall situation remains stable. The yuan-ruble pair is moving along the level of 13. No radical changes are observed, and current fluctuations are happening at the peak of the upward cycle. That's all for now. We continue to follow developments in financial markets. Subscribe to our channel and stay up to date with the latest news with us. See you soon!